I humbly believe that some governments manipulated the stock market last year by buying some of the lowest quality investments, which led to an unprecedented short squeeze that caused many hedge funds to reverse their short positions. Now, a short is the opposite of buying a stock. When you buy a stock, you're long the stock. When you short a stock, it's the opposite of being long, hence the name. And when you're short a stock, there can be unlimited losses if the stock goes up a lot. And as a result of this, from a risk management perspective, many hedge funds actually give up on a short if it rises by 10 or 15%. And so short covering leads to more short covering. And if the crappiest stocks go up a lot, then many hedge funds give up and they get out of their short positions. And government manipulation of markets is something we've seen in the past. And some people refer to this government manipulation of markets as slush funds or offshore accounts that certain governments use to buy stocks in order to push the market higher. Now, the US government pushed the market higher in September of 2008. How do I know this? I know this because I had friends that ran hedge funds, and the bank that my friends used to store their hedge fund positions, meaning their prime broker, was Lehman Brothers. And in September of 2008, the United States government allowed Lehman Brothers to go bankrupt. And the United States government seized all of the shares that Lehman Brothers hedge fund clients were short. And then in September of 2008, on a Friday, the government, what they did was they covered all those short positions, which drove the U.S. markets higher. And the government also on that day in 2008, they made it against the law to short about 800 different stocks for a while, including many banks and auto companies like GM, which we refer to as government motors. And I remember it well. I remember really well. I ran my hedge fund at that point, and we were tempted to give up and cover our shorts that Friday. But we did not do that, thank goodness, because and we were thinking at that point in time, if the government made it illegal for a while to short 800 stocks, then we'd have no great short positions left in our portfolio. And so I was humbly right at that point. Yeah, in hindsight. Rarely happens, but I was right then. So why did the market go up a lot at one point earlier in 2020 when the fundamentals were just awful for the markets? Doesn't make sense. Well, the best way to explain what happened is by talking about the two medicines that governments have to fix the economy. One of the medicines is called monetary policy, and the other medicine is called fiscal policy. Now, monetary policy is, as it states, the policy of money. When the economy is in terrible shape, what the government does is they print more money. And we know that if you increase the supply of anything, the price goes down. So when the government materially increased the supply of money in early 2020, the price of money, meaning interest rates, went down a lot. And the government made a few monetary policy mistakes. Number one, when the economy was doing incredibly well, or much better, from 2017 till 2019, the government should have had the foresight to raise interest rates more. They did not do this for certain political reasons. So when the economy was very sick in early 2020, they couldn't jumpstart the economy enough by cutting interest rates. The second monetary policy mistake the government made in early 2020 was the government actually cut interest rates by a full % on a Sunday. First of all, they never ever cut interest rates on Sundays, and certainly not by an entire 1%. That's a lot. So what happened was on the next day, on a Monday morning, instead of the market going up big time because rates were lower, the market sold off materially because the government caused people to freak out, because they made such a drastic cut on a Sunday by 1%. Then what happened was there was no more medicine left in the monetary policy bottle, meaning no more bullets left in the chamber to jumpstart the economy. Rates can go much lower. So this brings us to the second medicine that governments use to help the economy, which is called fiscal policy. Fiscal policy is basically everything else a government can do to help the economy that's not tied to interest rates. And fiscal policy includes stimulus checks, big public works projects like building highways, which helps with employment, etc. And there was actually concern that this massive fiscal policy was not going to help enough. So if you're a big government, what can you do to help United States consumers spend more money? What can you do? Right? If you're out of fiscal medicine and monetary medicine, there's no more medicine left. Well, the United States is the largest economy in the world. And 2/3 of the United States economy is consumer spending, not big business. It's consumer spending. And if you're the Chinese government, which is very much reliant on the United States consumer through exports, if you're the Chinese government and you're reliant on the US for exports, and if you're worried about civil unrest, then hypothetically speaking, wouldn't it make sense to buy US stocks as the third medicine to help the US economy? This wouldn't cost very much to do, and consumers would feel richer and spend more money, and everybody wins. And Machiavelli once said that the ends justify the means. And wouldn't it make sense to stop the next Tiananmen Square uprising and civil unrest by thinking about buying the most shorted United States stocks in order to cause hedge funds to cover shorts? And also from a FOMO or fear of missing out perspective, many other people started buying stocks as well. They jumped on the bandwagon. Perhaps one day this will become declassified, and we might know for sure if this really happened. And I would be shocked if this, I would not be shocked, I should say, if this did in fact take place, as the ends justify the means. Gotta love freedom of speech.